I've been having a lot of great conversations with people lately, and one of the things that I've heard the most is, "Oh, I already have the tools. I already know what to do." But when I drill down a little bit and I ask them how they have done, what they say is, "I've done okay." And then I'll ask, "Well, what is okay? Like, what is the actual number? Is it 1%? Is it 3%? Is it 5% a year?" And most of the time they won't know. And when I say most of the time, almost all the time, they won't actually know. And so when I have these conversations, I talk about the three tools that my clients use, the three tools that I use. And one of the tools that I use, and I'm not going to use the specific names, but one of the tools I use is it tells me what to buy and when to buy it. And I notice with a lot of other people's tools, it may tell them the what part or the when part, but it never tells them what to buy and when to buy it and actually how long to own it. So it's one of those tools that I often find missing in people's tool bin. The other tool, and there's only three tools I use, the second tool in no particular order is a tool that is used so you actually buy when you're supposed to buy. And one of the things I've noticed with investors over the last 2 decades of working with them is most people know what to do, and most people don't do what they know what to do when they're supposed to do it. And so I created a tool that helps investors actually take the action when they're supposed to take the action. It's a tool that almost no one has. And then the third tool I have is literally a tool that shows you what is working and what is not working. And I've noticed over the last 2 decades that most people don't have a tool that kind of shines a light on, well, what are the things I am doing that are working and what are the things I am doing that are not working? And what I've noticed is when you use these three tools together, people have this reliable, consistent experience with their portfolios and with their strategies and with their futures. And so with that, what I want to do is I want to show you one segment of the market that often doesn't get talked about, but we probably should start talking about it. Hey everybody, this is RC Peck, and this is my weekend podcast. And what I want to do is talk about the sexy industry called commodities. Now, commodities has basically 3 parts that go into it. And the price chart you're looking at is the CRB price chart, which is basically the S&P 500 for commodities. Commodities are generally broken down into 3 parts. You have energy, which represents about 40% of this price chart that you're looking at right here. You have agriculture, which represents another 40% of what you're looking at here. And then you have metals, which represents 20%. So basically you have 40 energy, 40 agriculture, and 20 metals. Now, if we are going to go back into inflation, then we're going to have to see the CRB index move higher. Now, it broke below its 1999 low, which was the same low in 2001. It broke below that, came right back up after. What's amazing is it didn't spend too much time down there. It broke down and spent maybe 6 months below and then popped right back up. So what I want to do is I want to look at those 3 segments, the energy, the metals, and the agriculture portions of this and see what it's telling us. And are we getting inflation, or is this just a reflation thing with interest rates? So the first one I will look at is the biggest, which is energy. And this is an ETF that represents the energy components of the commodity index. And as you can see, and I made it easier for you to see, that the energy components have been in an uptrend for the last year. Now this uptrend needs to continue. What's interesting is the majority of the component of this energy is West Texas Intermediate crude, basically U.S. oil. And what's going to be very interesting to me is we know, and if you've done any reading around how many rigs are being turned on and how fast fracking and horizontal drilling technology is evolving, you know that the U.S. has an incredible amount of energy. And as the price of oil moves higher, more and more wells, which are already dug, by the way, will be turned on. So if this continues to move higher, the energy portion of commodities, then that tells us that we do have inflation, because if a barrel of oil is going up in price And the U.S., which has the leading technology of extracting energy from the ground on the planet, are opening up more and more wells at a faster and faster pace, and energy is still going higher, then that tells us that yes, in fact, we are moving into an inflationary period because we can increase the supply very quickly. So this is the first component. And in fact, this is looking, I'll still call this reflation because a barrel of oil fell from $110 in mid-July to $26 at the very beginning of 2016, and then bottomed and moved higher. So I think I'm going to still call this reflation. I will call it inflation when more and more of those wells come online and the price is still going higher. And look, guys, the trend is higher, so the price is going higher. So I'm not dismissing that the price is actually going higher. I'm simply saying this is probably still more of reflation. This right here is the second major component of the CRB index, which is agriculture. Now, this is very different looking. This took a huge hit too, just alongside energy. And unlike energy, this is bottoming. In fact, we've had a double bottom. And I'm actually most excited probably about this because I think it's being ignored, and it does look like there's a double bottom. And in fact, there is a small upstart up channel, trending starting. So I'm going to call this reflation. First of all, nothing's moving, but as this does move higher, this will definitely add to the, for sure it's at least reflating. And this, we know agriculture will move higher. We just don't know when. When it moves higher, this is absolutely going to put upward pressure on the whole inflation conversation. And then lastly, that last section is metals. And metals is broken down into base metals and precious metals. The price chart you're looking at right here is, I just put gold on here to represent the precious metals, even though there's more than one precious metal. And precious metals is in an uptrend, though it's in a very wide uptrend with some volatility. But gold is moving higher. It bottomed in December of 2015 at about $1,050 and is moving higher, but is definitely giving people a run for their money on it not being a nice, easy, smooth move higher. But precious metals is moving higher, and that is inflationary. And then last, you have the base metals that make up metals. And again, much clearer move higher. It's in a very tight uptrending channel here. And so what we see is we do see commodities moving higher. Agriculture is lagging of the three main sectors. Metals is moving higher and energy is moving higher. So what's the takeaway? So a couple things, guys. Hold on, this came out in the wrong way. If commodities are waking up and not just kind of finding their bottom and bottoming, and based on the price charts, they are for sure waking up. If in fact they are moving higher, then we are moving into an inflationary period. We will move past reflation and move into an inflationary period. So what does that mean? It means it will be bad for bonds, right? Because that means if interest rates are going higher and the stuff you want to buy is going higher in price, like commodities, then the bonds you own, or I'll say it differently, if that 10-year treasury, you're not going to want a 10-year treasury at 2%. You're going to want a 10-year treasury at 4%. Well, if a 10-year treasury goes from 2% to 4%, that means the price needs to fall to adjust for that. And that's not going to be good for bondholders, which basically means it's not going to be good for people over the age of 60, because the conventional approach is that you put at least 40 or 50% of a person's money in bonds. And if bonds are topping out, that's going to put even more downward pressure on the bond owners. It will be good for companies that have to dig those commodities out of the ground. And in fact, that's what we're seeing. We're seeing material companies do well, base metal companies do well, precious metal companies do well. Agriculture companies are lagging, but they are starting to bottom and move higher. And energy companies have bottomed too. So it will be good for the companies that have to dig out all the commodities out of the ground. And in many ways, it will be good for kind of getting back to quote unquote normal when the central banks of the world took rates down to either a zero interest rate policy or used a negative interest rate policy. That disrupted a lot of people, especially people over the age of 60 who want interest rates being higher. So ultimately, it will help us to get back to, and I really am using normal in air quotes. The concern is that we will go from reflation to inflation. I know inflation's not a word. And then from inflation, we will go to inflation. And that means, and I don't think the Fed's going to be worried about inflation because what they would say to you is, well, we'll just crank interest rates higher. Okay, great. And that will crush the bond market. So we will continue to see more price volatility in the market. Unfortunately, I think a lot of that price volatility is going to find its home in the bond market. And that concerns me for people over the age of 60 who have a significant amount of their money exposed to bonds. Hey guys, this is just another step in helping you protect your portfolio and your future. Until next time, this is RC Peck. Hey guys, I put a new training together talking about the 5 shifts that I've noticed my clients over the last 20 years have used. And if they've used all 5 and made all 5 shifts, I've noticed that their money has grown much more effectively than, say, if they just used one of those shifts. Of those 5 shifts, 3 are tools. I talked about the tools to you at the beginning of this conversation. One of the tools being knowing what and when to buy. One of the tools showing you and having you actually buy it. And then the third tool in no particular order is showing you, well, okay, of all the things I'm doing, what is working and what is not working. And even people who have been in the investment world or in the stock market for 10 or 20 or even 30 years, what I've noticed is if they have these tools, they're using tools from the 70s. And I have never met someone that uses all 3 of these tools. Again, tool 1 being when and what to buy. Tool number 2 showing you actually, or kind of making you actually do the buy. And the third tool showing you what is and is not working and showing you how to fix that. When people are missing those tools or using those type of tools from the 70s, it definitely puts a lag on their investments, and they end up leaving a lot on the table. So I put that training together to introduce and kind of show how those tools can make such a difference. Hey guys, thanks so much for being in my world. I look forward to connecting with you both on this podcast and in my Facebook group. You guys take care.